Hey everybody, hope you're having a good start to the weekend. Happy Father's Day for everybody out there that has a father or is a father. If you're not, make sure you take care of your father, hopefully. Okay, this is the Trader User Group weekly roundup for the week ending June 17th, 2016. This is Preston Brent. What I'd like to do here is go over a couple of things. And this upcoming week is going to be a doozy. For our members, our Sunday night session, we're going to spend some time going over some assets that will either go up or down depending on this British referendum vote called the Brexit coming up June 23rd. Now, just understand that when do you find out what the vote is? If it's very close, it's probably going to go into the next day. But the polls in London close at 10 p.m. local time, London time. That's 5 p.m. New York City time on Thursday, which means if it is close, it's probably going to take well into the early morning hours in London or late hours here in the U.S. Eastern Standard Time to come up with an eventual winner. Hopefully, the exit polling will suggest which way the markets are leaning, or which way the vote is leaning, rather, and you're going to be able to start to make some plays. You're going to definitely see some front running in the markets. If you're not a member, I highly encourage you to, this would be a good time to come in and join. This Sunday night, I'm going to go through a list of assets that, should the British decide to leave, are going to be best affected and worst affected, and vice versa. Should they stay, which assets will move up and which will probably move down. So what I'm looking at right here, which is what hopefully you're looking at as well, is the daily chart of the EMinis S&P 500 futures. If we look at the chart here, you can see, and let me just put a little pattern on here so that you can kind of see what I'm looking at. You can see there's a major, well, that's just, you think I've been drinking all morning. Let's try that again. You can see there is a major support area right in that area there. And as I've told our members, right around the 2025, 2030 area, there's a big support. There's a big one right there, a little prior pivot low from this Elliott wave 5 swing down. Typically after an Elliott wave 5, you'll have an A pattern, a B pattern, and then a C pattern. And then after that, generally, you're going to say the pricing action will determine which way we're going to go, bull or bear. And sometimes it depends on where does the A leg stop, where does the B leg stop, where does the C leg stop. Now, this isn't in all circumstances, guys, but generally, this is what you can expect. At least a higher than a 50-50 probability. But that's about as good as you can get. But if we look at this support element, as I put on here, I'll put it back on here again. You recall that last time we were setting up for a head and shoulders pattern, but it didn't fire off. We had the left shoulder, we had the head, we had the right shoulder. Now, even in this right shoulder element, we still had this Elliott wave 3 up here and this Elliott wave 4. And if you guys recall, I was forecasting to move somewhere up in this area here. I thought we would get all the way up there. We did not. However, we did at that pivot high there, take out that prior pivot high there. So what that effectively did was take out that head and shoulders pattern. We did not get up as high as I thought. We formed a 5 leg. We had the requisite bearish divergence, and then boom, we got our trigger last Thursday to go short or start to lighten up on the low there, which is what we were doing. Now, coming into this week, it's going to be very interesting. Next Tuesday and Wednesday, Janet Yellen is speaking to the Senate Banking Committee, or the Senate Banking Committee. It's a semi-annual monetary policy report that she's given, and she's going to be asked a ton of questions. That's Tuesday and Wednesday. She'll have prepared text that the market participants will have access to before, but the questions and the Q&A session is what drives the markets, really. Now, the Feds, I just wish, and maybe some of them are listening, hopefully one or two will listen in on what I'm saying, because I've been saying this for quite some time. I wish they would shut the hell up. It's like herding cats. You've got some that go out there and want to be dovish. You got some that want to be hawkish. And every time they open their mouths, it affects the markets. I wish Yellen can control that group or just put duct tape on their mouth, as some of our members would like to see. A little bit harsh, but that's what I would like to see as well. And then just about 3 weeks, 2 weeks, 1 week leading up to the jobs report for May, that horrible jobs report, 38,000 jobs were created. Even Yellen, a few days before the jobs report, or a week or so before, came out and said she can see 2 rate hikes coming in the following months, which the markets interpreted as possibly June, because she said it was a live meeting, meaning that they could raise the rates in June or in July. So the probability of the Fed fund futures naturally priced it in. It jacked up the opportunity that happened, and then boom, we get that one jobs report. And then now all of a sudden we've got Bullard and others coming out and saying we might not see a rate hike until 2018. Not several, just one. And their official policy was 1 rate hike possibly this year, but we'll look at the data and see. I mean, that's about as clouded as you can get. I mean, it's beyond description. I think the Feds have kind of lost control. I think the markets just do not believe what they're saying. And if you follow the bond market, you look at the Fed fund futures rate, it'll give you what I believe is a more accurate prediction. It's what the Feds are saying now, to me, are just nothing but hot air. It's kind of like that Charlie Brown cartoon when the teachers speak and all you hear is wah, 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 like that. It's just insane. But anyway, nonetheless, we don't really care, quite frankly. We want to play where the market price takes us. And what I said, back down in this area here, we're going to see this. And at that point in time down here, if you recall, I said if we hold this for a couple of days, then the head and shoulders pattern would trigger, and it would take us down roughly to around that 1920 area, 1940 area. Well, now it didn't trigger. We moved up what I was, as soon as we got that trigger to go long there, I said, okay, we're going to complete this Elliott Wave 5 pattern, which is what we did, even though we did not move up and take out or test the all-time highs in the E-mini. We did take out this pivot high here, that prior pivot high, and you can see it provided support for about a week or so before we finally goosed it up there and took out that prior pivot high made on April 20th. And then we just kind of held it up there, and then we gave it all up very quickly. You can see the 200 EMA provided support. That's where we're sitting. But now we have the possibility of another potential head and shoulders pattern, believe it or not, where we've got this bump here, this one here, and then we could possibly move up like that. And then, you know, which way do we go? Do we have one of these things? If we come back down here again, now we've just shifted our head and shoulders pattern, right, to where we got a left shoulder head, right shoulder. Now, as you guys all know, this is the side of the chart we trade. This is the side of the chart that we base our bias on over here. And if we do it correctly, then generally, you know, we've got one of those kind of numbers, and we put the odds in our favor. There is no such thing as, you know, with certainty, but there is such a thing as you've got the odds in your favor and you've got an edge. And that's what we're looking for here. And looking at these charts, looking at these technical patterns, and then doing some of the other things that we do here in our user group to be able to plot where we think we're going to be. So this next week, as I said, we got Yellen speaking on Tuesday and Wednesday, and then we got the Brexit vote on the 23rd. As I said, the poll comes to a close 5 p.m. New York City time, and if it is a clear win, we're going to get that in the after-market hours after the market closes Thursday. There's going to be definitely some winners and losers depending on what happens. So if looking at this right here, this past week we just concluded with a down week, slightly off a little bit. The markets are still concerned with this vote. Now, it may turn out that Brexit turns out to be another Y2K moment. I don't know if many of you remember the Y2K, where we were going from 1999 to the year 2000, and a lot of computer systems, older computer systems, weren't designed to handle the year 2000. There were all these prognostications coming out that planes were going to fall out of the sky, the sun was going to never rise again, and everything was going to just come to a standstill. So there were a lot of consulting firms and other companies that came out that made a ton of money helping companies shift over for computer systems to be able to handle the year 2000. Automated lighting systems, all sorts of things. It was really good. I kind of laughed at that. But anyway, this Brexit vote could end up being a non-event, but I believe that will be the case over a 12-month period. Personally, I believe the British leaving the European Union would be a better thing, but that's not my call. But I think over a 12 to 18-month period, if they do leave, it will be good. If they leave, however, the markets, as you know, hate uncertainty. They hate surprise. They hate shock. And like a petulant child, price action always overreacts both to the upside and to the downside. So we can expect some price overreaction on the vote only because it's so damn close. If one camp was generally leading more than the other, then you would see the markets do what they traditionally do, which is price in the outcome before it happens. About 60 to 75% of the outcome would already be priced in. Because this is almost a even call, it's too hard to predict. The polling suggests that the leave vote is around 58% leave. So the polling suggests they want to leave. However, the bookies have it at 60% that they stay. The polling suggests 58% or so they leave. The bookies say 60% they stay. I tend to trust the bookies more than the polling, all right, because that's where the real money is placed. But again, it's still a lot of mixed results, so I don't know how this thing is going to play itself out. I do know, though, that if we come down and we let's say over the next few days, we stay in this range. We don't penetrate that pivot high at 2120 before the vote, and we don't take out that pivot low, or we clearly don't take out this major low sitting here around 2031, 2032, roughly. We don't take that out, and we just kind of pender around. We're going to break either that or we're going to break that near term. If we break this near term, our downside measuring objective is going to take us at least down to 1920 area. And you can see if I were to, that's the wrong thing. God, I must have been drinking bourbon this morning. But you can see this zone right here. Let me just put it in a little bit better here, like that. You can see right in this area here is where the measuring objective of a break right here will take us somewhere in this zone here. You can see right over here, it provided resistance for that big mass downflow in early Q1 of this year, and then we finally broke up here. It will then provide support should we break here, and then depending on whether we can hold or not will be determined whether we come back up to this level for another retest, or we break this level and come down and retest our lows made back in February the 11th. Okay, so these are the field of play that we're going to be watching for this week. And I don't believe anybody if they say they know what's going to happen. I've suggested to a lot of our members that you go a little bit more into cash, because there's going to be some great plays post-vote. Now, it could be that it is like the Y2K and nothing happens. I doubt it, but if it does and you've gone to cash, that's okay. You can go right back in again. But if what I believe is going to happen, we're going to have that initial shock for 3 or 4 days after the vote. Some asset values plunge, others go through the roof. And if you've got a little bit of extra cash, it's going to be worth the play. So that's kind of what I'm looking at right now on the SPDR or the S&P. Now, the markets really, we've got over 10 trillion in negative interest yield. It's amazing. And the bond market has just gone through the roof. You can see we made new highs in the bond market, 2016 highs of actually 171.07. We were in this range for quite some time, right in that area there. Okay, you can see it. Well, let me draw it just a little bit better here so I can get it a little bit more accurate. We were in this range right about there, all right? And you can see where we've sat. We broached it for just 1 or 2 days here and just 1 day right there. And then we found ourselves quickly back in this range. This was from the February the 11th lows right here. When we started making that big move up to that area there where we formed our 2016 high. And then we kind of stayed in this sideways trading range where we tested the lows, we tested the highs. Didn't quite get down here. We hit another support point. And then as we are coming into this British vote and it looks like the Leave is winning in the polling, it has put a lot of money into our bond market. Now, I have been saying this since Q4 of last year. I notice now a lot of the TV talking heads are picking up and others too as well. But in looking at the data, a lot of money is coming in. And it's just obvious, really, from Europe and from Japan primarily. A lot of that money is coming into our bond market and it's fueling that run up. Okay. Now, once Europe settles down and possibly Japan too, you're going to see that money sucked right back out of the bond market. We're going to find ourselves back into this hole right here, and then I think we're going to go down a little bit. There's going to be a limit to how low we go for the near term, but I think if the economy starts to improve, we've got a bubble here in the bond market, and going long up in this area here, to me, you've got to be batshit crazy, right? I mean, you just got to be crazy because it's just momentary. And granted, we can go up a lot higher, but that's just going to be areas here where I would be more interested in taking shorts than taking longs. That's the bond market. And if we look at the 30-year Treasury yield, the interest rates, you can see right now we are down actually lower than the lows we made on February the 11th. The lows we made on February the 11th, let me just get this set here. You can see right in this area here, the lows we made on February the 11th were right there. Okay. We actually took those out. Now, my prediction for interest rate yields, let me go back out to the weekly and I'll show you, it's a longer term prediction, was off of the pivot low back in the summer of 2012, was down in this area here. And this is exactly what we hit. We hit it a little bit early, but that was a long-term projection of an Elliott wave 3, 4, and 5. All right, and you can see the timing of the prediction, which is controlled by Gann. But what my software does is it combines Gann with Fibonacci extensions, and it gives me both timing and price. In this case, we came down and just touched right on it. And now it looks like we're working our way back down again in this area. But this is the, if we get a spike down here, guys, I'm going to be going long interest rates again. And I'm going to be shorting the bond market. It's just, it's too hard to turn down. That doesn't mean that we can't go lower. But longer term, this thing is going to settle in and then just kind of establish a glide path here that may be shallow, but it's going to definitely be in the up direction. So, but just so that you understand, going all the way back when we started this run up here and then we started rolling over back in December of 2013 and started working our way down. When I first printed this out here, people were saying, that's insane. Interest rates aren't going to get that low. But look at what they've done. If we look at the 10-year interest rates are what the mortgage market controls. You can see right in this area here, it's not as sensitive as the bond market. Remember the bond market, the 30-year bond market, further out on the yield curve is, yes, it's sensitive to what the Fed action is, what their monetary policy is, but it's also extremely sensitive to inflation. And the Feds have come out essentially and said there's not going to be any inflation for the next few years. Not unless they do more stimulus, and I think Yellen, from a political standpoint, is not going to do that. Now, we're going to have also, in another couple of months, depending on who's looking like they may win the political game here in the U.S., whether it's Democrats or Republicans, there's going to be some good asset plays there too, primarily in the bond market, but also in the medical market, infrastructure market, military markets. So we're going to be looking at those plays in another coming months. But right now we're focused on the Brexit and the dislocation or lack thereof that can cause in the markets. But this is the 10-year. And the 10-year, as you can see, is also lower than what we made on February the 11th. So we're really moving south of the border here because we're getting negative interest rates across Europe. We got 10 trillion in government debt that is below zero. So money is supporting our treasuries and our bonds, and that's what's keeping interest rates low right now. If we look at gold, gold had a big head fake. It was really amazing. If we come in, let me come down to a 15-minute chart, you'll see the big head fake that gold had. Gold ran up very strong and then gave it all up. I mean, very quickly, and now it's working its way back up again, okay, on this chart. I think gold is going to be one of those assets that is going to work its way higher, but not without chop. On this daily chart, you can see we've completed a 3, 4, 5 pattern, which then after, by definition, a 3, 4, 5 pattern does show instability, as I said, or another word could be chop like that, and then it decides which way we want to go, upside or downside. I suspect there's more upside, but we made a 2016 high on Thursday at 13.18. As soon as we hit that high, then we gave it all up, and then we worked about 50% of that move down, back off again. So as we move into Brexit vote, I think gold will kind of slide a little bit higher, and then based on, it's not going to go too much higher until post-vote results. But that's kind of where we are. Silver, as you guys know, I have been long silver, and I've been telling you guys about this one for quite some time. In fact, going back for about a year now, I was picking up silver down in these areas down here. Right in here. I did not sell right here. As it came back down, I picked up more, and now we're up right in this area here. Okay, you can see we're trying to make a run, trying to form one of these 3, 4, 5 patterns, which would suggest silver is going to go higher. So I'm holding this silver here, and it's also setting up for a bearish divergence, which is very typical of an Elliott wave 5 as you go back up. It's kind of like the last thrust up before it starts to roll again. So this is kind of what we're looking at in the precious metals market. We're going to get some really interesting movement out of that post-Brexit vote. In the energy market, as you guys know, off February the 11th, we over-allocated into the energy market. I liked it. It was really depressed. We did fairly well in playing energy to the upside. Here's the oil futures market. You can see the 50 EMA held very nicely. You can see some of these pullbacks here. That pullback there, that pullback there, this original one here, which gave us the trigger to the upside, that pullback there, this pullback here. Most of these pullbacks are met by buying around the 50 EMA, right? That's kind of what we're seeing, or what I'm seeing right now. That 50 EMA sitting, let's call it about 45.90. Should that lose out, we're coming down to the 200 EMA. Oil markets are very, like the gold markets, it follows technicals very well. Anytime you get a MACD that looks like that, where you've got multiple crosses in the signal line, all that does is indicate a grind higher and a consolidation. Sometimes price action can consolidate by grinding a little bit higher into an overall support or resistance zone. So we could have one of these kind of moves like this. So and I think oil is also going to be dramatically affected by the Brexit vote. It's going to move in sympathy with the equities and others. So let's stay tuned on the oil market. And for those looking at nat gas, we've had a huge run up in nat gas. We made 2016 highs on Friday. You can see that huge move off the bottom. Natural gas, more so than oil, is affected by temperature changes. And we're seeing some very hot summer months forecasted on lower inventory, so naturally this is going to move up. I'd like to see it run a little bit higher, and then I'll be more interested in playing some bear call spreads in this and just getting way out of the money. But you can see the 2016 open price, and we've established a new 2016 high in that gas. And then finally, soybeans. What can I say about soybeans here? We've had, this will be our 5th trade. We'll probably close down this week for a winner. This thing has just exploded to the upside. volatility in the call side has exploded dramatically, and it's allowed you to go extremely far out of the money and sell calls way out of the money, and I don't see soybeans getting that high. It could, but anything could happen. But the odds favor selling way out of the money calls in the soybean futures market, which is what we've been doing for 4 or 5 months, and it worked very well. Now, I know some of our members, when I had suggested we go long soybeans by or selling calls above, I said soybeans is going to move up. Some of our members went long soybean futures, and it's $50 a point. We've had a great move. Soybeans, by the way, moves a little bit faster than both corn or wheat. So soybeans has been a good play for us for 2015. All right, everybody, that's pretty much my update for the weekend for our members this Sunday night. Stay tuned. We're going to go through a lot of asset classes and what can be expected on the Brexit vote. If you're not a member, I highly encourage you to come in. We're having a really cool year. And as expected, both currencies and interest rates and debt is playing a significant role in where equities are going to be going this year. So otherwise, have a great weekend. Happy Father's Day to all. And I will pick it up this Sunday night with our members. Ciao, everybody.